Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about a Chinese multinational technology company. That company is Baidu. We'll be reviewing Baidu's annual filing with the SEC. Then we'll review the company's fundamentals by focusing on its key ratios. We'll perform a discounted free cash flow DCF analysis to find the intrinsic value of Baidu, and then calculate the expected rate of return to see if we were to invest in Baidu at the current stock price, what kind of return can we expect on this investment? So let's dive in and review Baidu. Hey guys, let's start off by looking at the Form 20F, which is the annual filing that Baidu did with the SEC. This is for the fiscal year that ended December 31st, 2020. And on page 68 of this report, the company provides a business overview. Baidu states that its mission is to make the complicated world simpler through technology. It is a leading AI company with a strong internet foundation. Next, Baidu talks about how it received the highest honorary recognition at the 2020 World Artificial Intelligence Conference. The company also talks about how its large portfolio of products and services is accessed by over 1 billion devices monthly, and its business spans across an ecosystem of hundreds of millions of users, millions of developers, and hundreds of thousands of enterprises. Baidu then discloses the 3 places that it contributes more than 70% of its revenue. Those 3 growth engines are mobile ecosystem, which is a portfolio of over 12 applications, AI cloud, which is a full suite of cloud services and solutions, and intelligent driving and other growth initiatives, which includes high-definition maps, valet parking, autonomous navigation pilot, intelligent electric vehicles, and so forth. Next, on page 130 of the report, the company provides its reportable segments. Baidu says that it has 2 reportable segments. The first one is Baidu Core, and the second one is Aichi. Baidu Core mainly provides search-based, feed-based, and other online marketing services, as well as products and services from its new AI initiatives. Aichi, on the other hand, is an online entertainment service provider that offers original, professionally produced, and partner-generated content on its platform. On page 125 of this report, Baidu provides a segment revenue breakdown. It shows the amount of money that's brought in from each operating segment. We can see that the online marketing services, which is within the Baidu Core segment, brings in more than half of the company's total revenue. The online marketing services saw a 4% growth in the year 2019 and saw a 5% growth in the year 2020. Next is the cloud services segment, which saw a 44% growth in the year 2020. Overall, for the year 2020, the Baidu Core segment saw a 1% growth. Next, looking at the Aichi operating segment, we can see that the membership services segment brings in majority of the revenue within this operating segment. The membership services segment saw a 36% growth in the year 2019 and saw a 14% growth in the year 2020. The online advertising services saw an 11% decline in the year 2019 and an 18% decline in the year 2020. Overall, when we look at the total revenue, we can see that there was a 5% growth in revenue in the year 2019 and a 0% growth in revenue in the year 2020. Next, Baidu talks about why it saw a decline in its online marketing services section. It says that it was mainly due to weakness in online marketing service demand, as its customers in industries that were negatively impacted by the COVID-19 outbreak and other factors, including healthcare, franchising, travel, financial services, and education, reduced their budgets on online marketing. Now that we have a brief understanding of Baidu's business model, its 2 operating segments, and the revenue breakdown across those segments, let's review the company's fundamentals by focusing on its key ratios. Hey guys, now let's look at Baidu's key ratios. I'm on Morningstar looking at Baidu. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. All the numbers here are in millions of Chinese yuan. Back in 2011, Baidu brought in about 14.5 billion yuan, and for the year 2020, the revenue was about 107 billion yuan. Every year for the past 10 years, the company's revenue has been increasing, except for the year 2020 when it saw a little bit of a decline in sales. Next, looking at the operating income. The operating income is what we get when we subtract the cost of goods and operating expenses from the company's revenue. Back in 2011, the company's operating income was 7.6 billion yuan, and for the year 2020, it was about 14.3 billion yuan. When we look at the past 10-year trend, we can see that the operating income plateaued out in the 11 billion yuan range from the year 2012 through 2016. And in the 15 billion yuan range from the year 2017 through 2020. Ideally, we want the company's operating income to be growing in lockstep with the company's revenue. And what we see here is Baidu's revenue has been growing. However, its operating income is not growing in lockstep with it. What this means is Baidu is unable to keep its cost of goods and operating expenses in check. Next, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it has paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2011, the company's net income was about 6.6 billion yuan, and for the year 2020, it was about 22 billion yuan. Over the past 10 years, the company's net income has always been positive. In other words, Baidu has always reported a profit since 2011. Next, looking at the dividends per share, we can see that Baidu does not pay out any dividends, and this is fairly common for a growing technology company, as the management believes that it is better for the company to reinvest its available cash into its core business, rather than departing from that cash and paying its shareholders dividends. Next, looking at the shares outstanding. Back in 2011, Baidu had 350 million shares outstanding, and for the trailing 12 months, it has 335 million shares outstanding. Over the past few years, the company's shares outstanding number has been decreasing, and this is good news for existing shareholders, as this process of buybacks actually helps increase the existing shareholders' ownership within the company. Next, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2011, the company's book value was about $5 per share, and for the trailing 12 months, it's about $82 per share. Over the past 10 years, the company's book value has been positive and growing. What this means is the company always had more assets than liabilities on its balance sheet, and the proportion of its assets in comparison to its liabilities has been growing. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Back in 2011, Baidu's free cash flow was about 5.8 billion yuan, and for the year 2020, it was about 18.8 billion yuan. I will be using the past 10 years of free cash flow for my expected rate of return calculation, and I will be using the 2020 figure of 18.869 billion yuan for my discounted free cash flow DCF analysis. Ideally, we want the company's free cash flow to be positive, staying steady or increasing, and that is what we are seeing in the case of Baidu. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to the revenue. Back in 2011, the company's net margin was about 45.78%. And for the year 2020, it was about 20.99%. What this means is every $100 that Baidu made in the year 2020, by the time it paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had about $20.99 left as pure profit. Next, looking at the return on equity. The return on equity compares the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities who had a return on equity of 8% or greater every year for the past 10 years. Apart from the one unique year back in 2019, Baidu's return on equity has been greater than 8% every year for the past 10 years. Next, looking at the return on invested capital. The return on invested capital gives us an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2011, Baidu's return on invested capital was about 50%, and for the year 2020, it's about 8.21%. Baidu's weighted average cost of capital, also known as the company's hurdle rate, is about 9.2%. And since the return on invested capital is less than the company's weighted average cost of capital, it tells us that the management is not creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage compares the company's income to its interest obligations. It gives us an idea of how many times can the company pay off its interest obligations using its income for that calendar year. Back in 2011, the company could pay off its interest obligations 112 times, and for the year 2020, it could pay off its interest obligations about 8.44 times. Benjamin Graham, the father of value investing, preferred to only invest in securities who had an interest coverage of 5 times or higher. Now let's look at the financial health of the company, focusing on the liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want the company's current ratio to be greater than 1.5. Back in 2011, Baidu's current ratio was about 3.6, and for the latest quarter, it's at 2.68. Next, looking at the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. Ideally, we want the company's quick ratio to be greater than 1.0, as it tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2011, Baidu's quick ratio was about 3.39, and for the latest quarter, it's at 2.54. Next, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. Ideally, we want the company's financial leverage to be staying steady. A high financial leverage tells us that more of the company's assets are financed via liabilities. Back in 2011, the company's financial leverage was at 1.53, and for the latest quarter, it's at 1.82. Finally, looking at the debt to equity ratio, this ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt to equity ratio to be less than 0.5. Back in 2011, the company's debt to equity was at 0.15, and for the latest quarter, it's at 0.36. These financial health and liquidity ratios are comparable to those of Google. Now let's look at the efficiency ratios, focusing on the days sales outstanding. This number gives us an idea of how many days go by from the day Baidu recognizes its sales to the day it actually receives cash for that service rendered. Back in 2011, it took Baidu about 11 days to receive cash, and for the trailing 12 months, it was about 27 days. Ideally, we want the company's day sales outstanding number to be staying steady or decreasing. However, an increasing day sales outstanding number tells us that the company is being aggressive in its accounting. In other words, it is aggressively recognizing its sales so that it can inflate its income numbers on its income statement. Next, looking at the payables period. This number gives us an idea of how many days does the company take to pay its suppliers. Back in 2011, it took Baidu about 26 days to pay its suppliers, and for the trailing 12 months, it took the company about 25 days to pay its suppliers. Ideally, we want the company's payables period to be staying steady. An abnormally high payables period in a calendar year tells us that the company may be hoarding on to its cash in order to artificially inflate its cash flow numbers. Finally, looking at the receivables turnover, this number gives an idea of how efficient the company is at collecting its receivables. Back in 2011, the company's receivables turnover was about 32 times, and for the trailing 12 months, it's about 13 times. Ideally, we want the company's receivables turnover to be staying steady or increasing. However, in the case of Baidu, the receivables turnover has been declining. In other words, the company was better at collecting its receivables back in 2011 than it is today. Now let's compare the company's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Baidu's PE is at 18.1, whereas S&P 500 is at 27.6. Baidu's price to book is at 2.3, whereas S&P 500 is at 4.3. Baidu's price to sales is at 3.8, whereas S&P 500 is at 3.1. Baidu's price to cash flow is at 16.8, whereas S&P 500 is at 17.4. And finally, the dividend yield. Baidu does not have a dividend yield because it does not pay out any dividends. However, S&P 500 has a dividend yield of 1.5%. We can see that on all these valuation metrics, other than the price to sales and dividend yield, Baidu is undervalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for Baidu. Over here, I pasted the 2020 free cash flow number that I got from Morningstar, which is actually 18,869 million yuan. And using the current conversion rate of 1 Chinese yuan equaling to 0.16 US dollars, we get the 2020 free cash flow to be $3,019 million. I expect the annual growth of free cash flow to be 6%. What this means is I expect Baidu's free cash flow to grow at 6% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I expect this investment to give me a 10% return. I'm using a long-term growth rate of 4%. What this means is I expect Baidu's free cash flow to grow at 4% every year after the 10-year mark into perpetuity. The company has 335 million shares outstanding and has a long-term debt of $9,654 million. After taking all of these inputs into account, we get the intrinsic value to be about $149 per share. And when we compare this intrinsic value to the current stock price of about $189 per share, we can see that the current stock is trading about 27% above the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $25 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $59.6 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $149 per share. Now, if we disregard the perpetuity component, in other words, if we think that Baidu is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $45 per share. And if we disregard the debt, in other words, if we think that Baidu is going to grow for the next 10 years and into perpetuity, and we just forget about the fact that the company has any debt, then we get the intrinsic value without any debt to be about $177 per share. Finally, if we drop the company's discount rate to 9%, which is in line with the company's weighted average cost of capital, also known as the company's hurdle rate, then we get the intrinsic value to be about $187 per share. And when we compare that to the company's current stock price, we can see that there isn't a lot of difference. In other words, the company's current stock price is neither under nor overvalued when the discount rate is 9%. Hey guys, now let's look at the expected rate of return calculation for Baidu. Over here I pasted the past 10 years of free cash flows that I got from Morningstar. All the numbers here are in millions of US dollars, and I use the conversion rate of 1 Chinese yuan equaling to 0.16 US dollars to come up with these numbers. This is the yearly free cash flow trend that we get over the years. We can see that this free cash flow trend has been facing upward. Even though there were a couple years when the free cash flow declined, the free cash flow was positive every year for the past 10 years. Next, looking at the future data and predictions, I'm assuming that there's a 35% likelihood that Baidu's free cash flow will grow at 8%. There's a 50% likelihood that its free cash flow will grow at 4%, and a 15% likelihood that its free cash flow will grow at 3%. These are the potential free cash flow rates that we get into the future. After taking into account the numbers of shares outstanding, which is 335 million shares, at the current stock price of about $189 per share, we can expect to get an annual return of about 5.4% on this investment. What this means is if you were to purchase a share of Baidu at the current stock price of about $189 per share and hold the security through 2060, then we can expect to get an annual return of about 5.4% on this investment. Hey guys, now let's wrap it all up. Reviewed Baidu's 20F annual filing with the SEC. We saw that the company has two reportable segments, the Baidu Core segment and the iQIYI segment. Baidu's revenue has been increasing for majority of the past 10 years. The operating income, on the other hand, is not growing in lockstep with the company's revenue, which tells us that the company is unable to control its cost of goods and operating expenses. We saw that the company's net income has been positive every year for the past 10 years. Next, we saw that Baidu does not pay out any dividends, which is fairly common for a growing technology company. On the other hand, Baidu does buy back its shares, which actually helps increase the existing shareholders' ownership within the company. Baidu's return on equity has been greater than 8% every year for the past 10 years. However, the company's return on invested capital is less than the company's weighted average cost of capital, which tells us that the company's management is not creating value for its shareholders. Next, we saw that the company's interest coverage is greater than 5 times. After that, we looked at the company's financial health and liquidity ratios and saw that Baidu's current ratio, quick ratio, financial leverage, and debt to equity ratio were comparable to those of Google. Next, we looked at the company's current valuation and saw that on majority of the current valuations, Baidu was undervalued when compared to the S&P 500. From an efficiency standpoint, we saw that Baidu has been fairly efficient. However, when we looked at the receivables turnover ratio, we saw that Baidu was a lot better at collecting its receivables 10 years ago than it is right now. Next, we performed the discounted free cash flow DCF analysis and found that when we use a 10% discount rate, the company's intrinsic value came to about $149 per share, which would indicate that the current stock is trading about 27% above the company's intrinsic value. However, when we drop the company's discount rate to 9%, which is in line with the company's weighted average cost of capital, we got the intrinsic value to be about $187 per share, which is in line with the company's current stock price. Next, we calculated the expected rate of return calculation and found out that if we were to invest in Baidu at the current stock price of about $189 per share, then we can expect to get an annual return of about 5.4% on this investment. Overall, we saw that Baidu is a good company, it has little to no debt, and has a long road of growth ahead. Baidu may be a good pick for an individual who is trying to get exposure to the Chinese market, as about 97% of the company's net revenue was generated within China. Finally, as value investors, we have two criteria. First, we want the stock to be cheap, that way we have a greater margin of safety. And second, we want the company to have a long runway of growth ahead. Baidu certainly has a long runway of growth ahead, however, it is not cheap. From an opportunity cost standpoint, Alibaba would be a better Chinese investment than Baidu. Hey guys, that is all I had for you this week. Hopefully you found this video on Baidu interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions as to which stock I should review next, please leave it in the comment section below. I will greatly appreciate it. Thank you.